Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name is Zhong and welcome to the latest installment of our 2024 Second Half Outlook podcast mini-series. In this podcast, I want to discuss in a little more details about our outlook on the equity markets in the second half of 2024. We have been positive on equities for a while now and remain so for now. It's certainly worth digging into the regional and sector preference. To do that, I've invited my colleague from the equity strategy team here at the CIO office, Daniel Lam, Head of Equity Strategy, and Fook Hien, Senior Investment Strategy. Welcome both. Daniel, maybe you can go first. In our previous podcast in the mini-series, we talked about equities being an asset class we prefer. Can you elaborate on your thoughts and preference for the different region, please?
Thanks, Zhong Liang. We overweight US equities. So if you look at the macro front, US inflation is cooling down, and that supports corporate margins. We're expecting a potential Fed rate cut in the second half of the year, and that continues to support growth stocks by alleviating the impact on discounted future earnings. Now, earnings growth themselves have been very strong, and the numbers for 2024 and 2025 have been revised higher since the start of the second quarter to 10.7% and 14.2% respectively. And also the future guidance lends comfort to the stocks with the AI theme driving the broader markets higher. Now let's look at the other regions. So for Japan, we actually downgraded to core holding or neutral. We know that there's still strong catalysts there, like the improving shareholder returns via the Nippon Individual Savings Account reform, and also cash savings is robust amongst local citizens. However, we do take note of the extended negative signals from a short-term technical model. And we see that the recent stagnant growth in the market to extend near term, especially after such a rapid re-rating since late 2023, and the valuation is no longer so cheap, it's trading around the historical average. So elsewhere, I'd like to highlight that we have a core holding or neutral view on XJ equities, with India being our overweight within the region. So election is past us now and the risk is largely behind us, and the medium-term outlook in Indian assets remains strong. Looking at its robust economic outlook and corporate earnings growth. And the longer-term catalyst is still attractive, like favorable demographics and growing middle-class consumption. Now finally, there could be some short-term opportunities in euro area equities because of the looming French snap elections. So we're already seeing some rotation in euro area equities amongst its own sectors as well as its own countries. And for euro area equities as a whole, we upgraded to core holding neutral because there has been easing ECB and improvement on manufacturing data. Thanks.
Quite a bit there, but I'd like to zoom in on the US equity. Are you not concerned that the prices of US equity is already too high?
No. This is common pushback amongst clients, but I'd like to point out that US equities tend to perform very well after reaching all-time highs. So if you look at the historical data since 1988, the US equities made an average of 6% and 13% in the 6 months and 12 months after making all-time highs. So yeah, it is high, but it can still go higher, according to the historical analysis. And we believe that US earnings growth is broadening out to other areas. So we're seeing areas related to Mag 7 to be doing very well, such as infrastructure service providers to IT and AI PC, etc. And finally, you do pay for what you get. So we look across different markets and plotting their price to book ratio versus their return on equity. The standout market on the top right-hand quadrant is the US. So the valuation is justified by the high return on equity.
Thank you, Daniel. Maybe let's move to Fook Hien. Can I just ask you about any sector preference we have and which equity sector will you highlight as attractive right now?
Yeah, thanks, Zhong Liang. We have opportunistic buy ideas, which are shorter term that clients can add on to their foundation portfolio. And at the moment, we have three sector focused opportunistic ideas, which are the US technology sector, the US communication services sector, and the Japan banks sector. So, with US technology, we believe the market environment favors strong earnings growth with good visibility, such as the growth driven by AI spending and cloud computing. Now, valuation of the technology sector is higher than the broader market, but we expect a slowdown in inflation to support the valuation of growth stocks. And with US communication services, the sector offers strong earnings momentum from digital advertising and the demand for online entertainment. So, similarly, we expect the growth sector here to benefit from slowing US inflation and lower bond yields. And Japan banks is a new idea we added this month. We believe that an expected rise in Japan's interest rates, it would support banks' interest income, and the high capital market activities as well could boost fee income for the banks. The profitability outlook is good for the banks as they reduce the unprofitable shareholdings and they reinvest into your higher profitability businesses. The major banks, they also have share buyback tailwinds on top of dividend yields of a 2.5 to 3.5%.
Apart from the opportunistic sector views, do you have any opportunistic ideas in the Asia region, maybe outside of Japan?
Yeah, in the Asia ex Japan region, we also have three opportunistic ideas, one within China, and then two country focused ideas on India large cap stocks and Taiwan equities. So in China, we like the non financial high dividend state owned enterprises or SOEs. We see investor demand for high dividend SOEs as the SOE management teams they continue to have an incentive to work on improving their market value. And we focus on non-financial SOEs due to the lack of clarity on the financial sector support for the distressed property sector. And with India, we expect policy continuity from the new coalition government that remains pro-growth. So a reduced mandate for the ruling NDA alliance is likely to lead to a sharper focus on rural, infrastructure, and green energy spending, which should boost job creation. We expect India's superior growth to continue supporting the market there. And then with Taiwan equities, momentum has been strong and we do expect this to continue. Semiconductor manufacturing has a large weight in Taiwan equities and it benefits from global AI adoption and cyclical headwinds in non-AI demand. So this gives a strong support to Taiwan equities.
Well, that's a lot of beneficial information. Thank you, Daniel and Fook Hien, for walking us through our H2 equity views. We hope that you enjoyed the podcast. And if you do, please do not forget to like and subscribe to the SC Money Insight channel. We'll be releasing the remaining installments of the podcast mini-series over the week. We wish you a great week ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.